Well, good morning. Thanks to those of you who have joined me already. I'll probably just hold off for a few more seconds just to go and give some more of the audience time to go and assemble in the virtual waiting room. Yeah, look, it's been another pretty interesting week, and once again, one dominated by what we're looking at when it comes to US economic exceptionalism. So I thought today I would go and focus on that and just show how the US economy, relative to what we're seeing in other parts of the world right now, is really, really looking good. And it's helping to go and fuel high US interest rates and a stronger US dollar. Before we go and get into any of the details, just a quick reminder that this is advice in nature of the presentation. All of these are those of my own. And if any questions do come apart at the end of the other presentation, where you can go and shoot them through on the YouTube live platform, please send them through. But I will not be considering your personal circumstances, and it's your choice to go and participate in this particular forum. Let's go and have a... There I am. Hope everyone's having a fantastic morning. Yeah, look, it's been a really interesting week. Again, characterized by the strength in the US economic data. We saw that again last night. I know that when I did my YouTube live last week, I was really anticipating we might go and see a pullback in US yields and also maybe some weakness coming through in the US dollar temporarily because of the threat posed by weather on initial jobless claims and how the retail sales report had to go and really go and exceed expectations. Well, both really blew expectations out of the water again. For the better, again, seeing some more US dollar strength coming through, and a really interesting move as well on the DXY that we'll get to in just a moment. With that, look, might as well just get straight into it. The first thing you can see on your screen now is Citi's Economic Surprise Index. I featured it a few times, but I thought I'd go and delve into a little bit more beyond the US side of the equation. So from top to bottom, we have US economic data, we have Euro economic data in grey, we've got Chinese economic data in red, we've got Japanese economic data in yellow, we have British pound data in blue, and then down the bottom, you can see in Aussie economic data as well. So what is the Citigroup Economic Surprise Index? Well, for those who have not come across it, basically it goes and captures how economic data prints relative to economic forecasts. And when you have a figure that's above zero, it indicates that more economic data than not is topping expectations. Now, when you look at this particular chart, one thing really stands out. After a period of underperforming for quite a while, what we've seen over the past month or so is that there's been a big uplift in the US reading. So it's now actually the point where it's gone and increased to the highest level that we've seen in around about 6 months or so. And so what we're seeing is that more often than not, the US economic data is topping expectations. But just go and compare that to what we're seeing in other parts of the other world. In Europe, still mired in negative territory. China, still very negative. Japan, for all the hopes about how this virtuous cycle to go and spur on economic growth and the like, clearly not having much of an impact. It too is in negative territory. So most economic data surprising on the downside. And even in Britain, which has been kind of the poster child for having such a strong and resilient economy recently, we've actually seen that its surprise index has also gone and dipped into negative territory as well. So ever so slightly more misses than beats right now. One of the exceptions to the broader rule, though, is what's going on in Australia down in the bottom pane there. It's actually risen to the highest level since January this year. So that is showing you that the Australian economy, despite all the doom and gloom and all this expectations that the RBA is going to go and cut rates at some point in the near term, well, the economic data suggests maybe hold your horses, because it is increasingly beating on the top side. And you've seen that when it goes to RBA interest rate expectations and the like. They have really been curtailed over the course of recent weeks. So US economic exceptionalism, bar what's happening in Australia, looks pretty standard at the moment. It looks like that's the current trend. And it's filtering through to expectations for what the Fed's going to do with interest rates. You can see here in the left-hand pane, we're looking at the number of rate cuts being priced into the Fed funds futures curve out to the end of 2025. And not that long ago, we had more than 9 25 basis point cuts that were being priced in. But fast forward to today, we now have less than 6. And you can see where the trend is going right now. Yes, it hasn't managed to go and curtail any more of that at this point in time, but certainly the trend is that we're seeing rate cut bets whittled away like we saw at the very start of this year. It feels almost identical. The only difference is that maybe we're seeing some signs that inflationary pressures are a little bit less so than what we saw back then. But then the last 2 inflation reports in the United States have both beaten expectations. What you can see in the right-hand panes, in the top, you can see the expectations for what the Fed is doing is filtering through to what's going on in 2-year US bond yields. And you can also see in the bottom pane on the right-hand side, that's US 10-year yields, and they too have been trending higher. So that's really important. So what we're seeing is that the economic data in the States is by and large impressing, especially the really key data points at the moment, and it's filtering through to expectations that the Fed is not going to cut as much, and that's filtering through to higher US yields further out the curve. And that has been incredibly influential on the G10 FX universe. And so I just wanted to go and explain what this particular chart is at the moment. So we have on the left-hand pane, US 2-year yields, the rolling 20-day correlation with a variety of different FX pairs. On the right-hand pane, it's US 10-year yields, the rolling 20-day correlation with the same FX pairs. And I just wanted to go and use that because it's basically looking at the relationship that we've seen over the past month on a daily time frame. And it's really, really instructive just how influential the US interest rate outlook and US interest rates more broadly are on the G10 FX universe. So from top to bottom in purple, you can go and see Euro 2s and 10s curve sitting around about minus 0.9. So a really strong inverse correlation. So when US yields move higher, Euro has been almost always moving lower, and that's been the prevailing trend. It's the same deal for sterling. For cable, you can see there in red, minus 0.9 for 2 years, minus 0.92 for 10 years. Incredibly strong inverse correlation again. It's even more so when you look at the likes of dollar yen. You can see it's a positive relationship. 2 years, 0.94, 0.95 for 10 years. So just, you can see there across the universe, Canadian dollar in yellow, you can see very strong as well. And even the likes of the Aussie, despite the economic data we're seeing at the moment, you can still see that it's really, really influential at this point in time, as well as the Kiwi in the bottom pane as well. So it really is the US interest rate outlook, which remains the key driver of movements in the FX space right now. Just to go and underline that point, left-hand pane, you can see here, this is yield spreads, 10-year yield spreads. From top to bottom, we have US, Germany, then we've got US, Great Britain, US, Japan, US, China, and US, Australia. And you can see all bar the other spreads between US and Australian 10-year yields in red. What we've been seeing over the past month or so is that there's been a continuous upward trend. Didn't all start at the same time, but yield spreads are widening in favor of the United States. And you can see there on the right-hand pane, what we're looking at is the actual movement in a variety of different FX pairs. So what I've done here, I've gone and flipped the actual scale for Euro, for cable, and for the Aussie dollar, just to go and show that what we're looking at the moment, so as yield spreads have widened, at the same time, that's corresponded with an increase in the dollar versus those particular pairs. The only one that might go and kind of look a little bit strange right now is the Aussie dollar, and the Aussie dollar could probably be explained by what we're seeing in China. Yes, the US Aussie spreads are pretty much stable at this point in time, but when you look at the correlation with a variety of different China-linked assets at the moment, they seem to also be pretty influential on the Aussie at the moment. So it probably explains why the Aussie dollar has been under a little bit of pressure despite that economic resilience that we've seen recently. One thing that's been coming up as well a lot recently is the Trump trade and the potential as to what exactly influence it's having on markets, because clearly there is some speculation out there at this point in time that Donald Trump not only could become president again, but also that we could go and see a red wave. When you talk about the Senate, which the Democrats currently hold, they only hold a majority of 2. And there's going to be 34 contests in the upcoming election. And of those, vast majority are Democratic held. So the risk of a red wave is definitely increasing, which is interesting at the moment because whilst we're seeing things like small cap US equities and the like, US equities more broadly, the US dollar, really seeing some pretty powerful moves at the moment in anticipation that we might go and see Trump come in and tariffs and the like protectionist kind of policies. The charts on your screen are looking at the shape of the US Treasury curve. On the left-hand pane, it's the US 2s 10s curve. So 10-year US nominal bond yields, less 2-year nominal bond yields. On the right-hand side is the US 2s curve. So 30-year nominal yields in the United States, less US 2-year yields. And what we're seeing is that there's been a steepening take place over the course of the past few months. And that would indicate that, that yields relative to those at the front end of the curve are starting to blow out. But when you actually talk about the big push towards this notion that Trump is going to win the presidency, I'm not doubting that, but the bond market is not giving me any really strong signal that that's the case because we know his policies are very reflationary, plans to go and run big budget deficits, and what that would go and do to the back end of the curves and what it should do with yields, to me, means that potentially if Donald Trump is really being priced in as a strong favorite, not only to win the presidency, but also see the red wave, we'll see these curves steepen quite aggressively. So at the moment, yes, we've seen that taking place, but for all the other talk about the polling and everything else recently, we're actually seeing that the curves itself have flattened a little bit. So keep a close eye. If Donald Trump becomes the real favorite, what we're likely to go and see, in my opinion, is really some big upward pressure on long bond yields in the United States. And that could go and start pressuring some long duration assets and would also help to go and fuel that US dollar strength story. Here's a playbook that I'm going to go and abide by over the course of this week. Until proven otherwise, buying US dollar dips and breakouts. Now, I should have a little asterisk next to that because we're going to have a look at euro on the daily chart in the not too distant future. And we are seeing signs that we're getting very oversold. And the US dollar index itself is now overbought as well. So there is the risk that we might go and see some kind of pullbacks. But if we do see those pullbacks, I'll be looking to go and buy dollars because right now there is clear the momentum is heading in that direction. We'll go over a quick look at the US economic data calendar coming up, but I can promise you next week there is almost nothing that's going to go and really move the dial, especially in the United States. So to me, it's going to be really important to focus on what Federal Reserve members have to go and say, because the risk of the Fed skipping the November meeting, holding off actually delivering a cut, is growing. And you're looking at the data, you're looking at the data surprises, you're looking at the upside surprises in the labour market, inflation data, and it looks increasingly like Powell panicked back in September, and we might need to go and see a pause. So I'm going to be paying very close attention to what Fed members have to say. When it comes to movements in the dollar and for bond yields and the like in the States, to me, that's going to be the key thing to focus on. Again, just getting back to that initial point, the political polls, keep a very close eye on that, especially the impact it might go and have on longer term US yields. Given the quiet calendar, I will be also putting more weight on price signals and technical signals in the week ahead, rather than trying to go and focus on any particular data event. If there is any movement in the week ahead from any of the economic data or events that comes out, signs maybe a few, there's a Bank of Canada interest rate decision, I'm inclined to go and fade it and pretty much ignore it because it's not really going to go and change the story one way or another. For those of you who like to go and look at the US equity space, we start to go and see the big boppers, the big tech earnings start to come through next week. And for us in Asia, Thursday morning, we get Amazon and Tesla reporting their Q3 results. So that will be a key moment. Again, though, whilst they're very big names, when it comes to the broader tech space, obviously some of those chip makers remain the really key ones there. And NVIDIA will not go and report until far into earnings season. So even Amazon, Tesla, whilst they will go and carry a lot of potential to move markets around, move equity markets around, and more broadly macro space, that to me is not going to be the biggest one to go and kind of consider. Let's have a quick look at the calendar just to go reinforce what I was been talking about there. You can see, so coming up this week, almost nothing. The China loan prime rates coming through on Monday. We've just recently seen them cut. So yeah, I don't really go and expect we'll see anything too substantial out of that. We've already seen a lot of easing measures for the property market coming through. And then you go and look at what's coming up outside of that, and it is really, really noticeable about how quiet it is. Yes, there's some Fed speakers that are coming up, so keep a close eye on those. But the information that we've got to go and digest here, well, there's almost nothing really meaningful. Just going through the list here, all times for Australian Eastern Standard Time, if you're wondering. Regional manufacturing surveys are not going to go move the dial whatsoever. Looking here again, not much. The Bank of Canada interest rate decision will be an interesting one. Markets and economists are marginally favouring a 50 basis point cut. The inflation data that came out recently really was in line with expectations. The headline rate is very weak, but still we're seeing the trims and some of the underlying measures in Canada still remaining pretty sticky. So I wouldn't go and put it as a slam dunk case. So that could go and generate some near-term volatility. But apart from that, there's not a lot to go and hang your hat on whatsoever. When you look at some of the PMIs that will come out on Thursday, it might be a bit more influential on the European FX names, but realistically, they're not going to go and move the dial until we go and get into the start of the month and we get the US ISM PMIs, both for services and manufacturing. Looking at some of the data that we might go and get on Thursday that could be of interest, of course, we get jobless claims. We saw them last night. We know that weather disruptions still carry the potential to go and really go and flip these around, but that's one of the few things to go and focus on next week. Apart from that, no new home sales. Again, all the data coming out is not really going to go move things. Tokyo inflation in Japan is another one to go and keep a little bit of an eye on. I disagree with the sentiment here that it's a minor event, because we saw an upside surprise coming through in the Tokyo reading last month. So we get another one here. No, 2 times makes a trend, in my opinion. MLF announcement from the PBOC. They've just recently cut it. So again, not anything that's going to really go move the dial. Durable goods orders, no. Final consumer sentiment reading, So it's going to be a really, really quiet week. And I just want to go and just demonstrate that. So to me, that's one of the reasons why I want to put a lot of weight on signals that come from both prices and from technical indicators. Let's get into it and have a look at some of the other details, what's coming up. I want to go and kick off having a look at the DXY. I'm just going to get that up on the screen now. Yeah, so we're talking about being price-driven signals. Well, yeah, right now, this is what you call beast mode, I think, in the technical world. US dollar index is just relentless in its march higher. Broke this trend line here with pretty much ease, then tested it a few times, then bounced off, and it just kept going over the course of this week. One thing I'd go and notice here that we can see it's now in overbought territory, and that is rare to go and see it so overbought. If you go back over time, the times that we have seen it this overbought in the past, it's typically gone and corresponded with times that we've seen market tops. So it's a warning not to go and get too bullish, and that's why I'm paying close attention to price signals right now. And if we do get a pullback in the dollar, it will be something that I'll be looking to go and buy. But you can just see, zooming in a little bit again, it's gone and stalled here. So it's actually managed to go and claim the 200-day moving average. It's just going and testing that level now, but you can see here at 103.866, it went and kissed that, so that's now become a new level. But just given what we're seeing with the trend at the moment, it's just onwards and upwards for the DXY. Let's explain why the DXY is going so strongly. Euro, yuck, unless you're short, of course. And I must freely admit that I was starting to get a bit fiddly with the euro earlier this week. I was expecting that we might go and see a bounce off this long-running trend line. But yeah, I was just too impatient, and just a reminder just to go and wait for the signal. And because we'd seen a couple of bounces off this level, it wasn't enough alone to go and get long. But you can see here, broke this trend line with ease, back tested it, and then it's also gone and done away with a 200-day moving average. Not a level that's been respected a lot in the past, it's got to be said. But then again, we saw after the ECB went and cut 25 overnight, went up, kissed that level, and you can also see there's a horizontal support level and resistance level just above. And now again, so we're looking at 108 is the next level that I'll be paying attention to. Then we have long running uptrend here. Very oversold. And again, like with the DXY, when it's been this oversold in the past, what it's generally occurred around times that we've seen some kind of turning point for the euro. But I'm waiting for a price signal. There's been no definitive price signal whatsoever suggesting we've got a market bottom at this point in time. Wait for the signal. That's the best way for me to go and explain to play it in the week ahead. The yen is something that I follow very closely. And it's been a pretty important 24, 48 hours here. You can see this is a kind of a trend line that was acting as support, was broken, briefly acted as resistance, then again became support. Then it traded through it, and I thought, this area here from 149.75 up to 151.95 is what I would describe as being a really, really strong support resistance zone for dollar yen. And we've now started to go and make an attempt into that potential zone. So we're now trading above 150. I don't put a lot of weight on the big figure. Yes, it gets a lot of attention. I've also read some stuff about it. It potentially might go and get Japanese authorities itchy to go and intervene again. I really would be surprised because it's all been driven by US rate differentials right now. So next stop, now that we're having a crack at this resistance zone, 150.90 is the next level that you'll be paying attention to. You can see here, 149.75 now might go and revert to being support. So you can go and buy that level. And then above, we've got a trend line, which runs back to around about the start of last year. And you can see above that, 151.95 was the previous high that we'd seen, the multi-decade high. And the price earlier this year just could not go and break that through for a long period of time, then eventually did and broke higher and went above 160 and the like. So yeah, this area here is going to be a tough slog. And what it's going to need to go and continue to go and grind higher here is either a shockingly strong Tokyo CPI number out next Friday, but more likely it would require the Fed and FOMC speakers to go and start pushing the market to go and expecting no cut coming through in November. So still a bullish trend, undoubtedly at this point in time, but again, to go and get above 151.95 will be tough. If it gets there, then it could really go and have a run higher, in my opinion. Have a look at the Aussie as well, because it's there we go. Bit of a stall there. Yeah. Aussie hasn't really been feeling the love despite some of the other strength in the domestic data that we've seen recently. You can see here on Thursday, following that jobs report yesterday, had a pretty decent crack at trying to go and break above 67 US cents, and then really didn't manage to go and do it. But impressively, despite the data out in the US overnight, it has managed to get back up towards that level now and is testing 67 as well. If it was to go and break that, you basically look to go and buy potentially. I'd only be looking to buy if it went and clipped the high that we saw on Thursday. And then you could go and look for a move back to either the 50-day moving average, or you can see here, the price stalled out above 67.60 a few occasions early this week and late last week as well. On the downside, 66.60, you can see double bottom in place right now. From a momentum perspective, RSI 14 has broken its downtrend, so that bearish momentum that we're seeing looks like it may be starting to go and turn. Not yet confirmed by MACD. But the Aussie's hanging tough. But again, a lot of what's going on right now is not so much about what's happening in Australia. It's about the US rate story and also about some of the concerns about not any big bang stimulus coming through in China. And until those concerns are removed, the Aussie is going to be very difficult to get excited about. To me, even though the resilience we're seeing in domestic data, it's still a sell on rallies play when it comes to a longer term and medium term bias. I might go and put the disclaimer back up on the screen now. Those of you who are here, any questions that you have, please shoot them through to me and I'll happy to go and look at those questions. Otherwise, we'll wrap up for this week. Looks like everyone has got enough information for today. I want to go and thank you for those who joined and really look forward to going and seeing you again next week. Again, if you do have any questions and you enjoy what I've got to say, please shoot them through and let's make this interactive. I'll see you next time.